What's up, guys? Chris Nahibi here. We are talking about Airbnbs. Why do I not do them? What do banks look at? How do you operate a successful one? Why do people tend to go towards longer properties? Most banks typically underwrite apartments or investment property based on the monthly cash flow. They project how much that property is going to make and then deduct the expenses. And when they do that, they come up with something called the debt service coverage ratio. Basically, for every dollar in profit, how much in expense do you have? And for every dollar in expense, you should have $1.25 or more on average in profit. You can't really do that with hospitality properties or transient properties like Airbnb properties because there's so much volatility in how much those properties make. They can be seasonal. They can, have a good, owner who runs it like a great business. There's a lot of moving parts and pieces to a hospitality-based business. It's also why getting loans on hotels are generally more difficult because that's really based on a per room average per night as opposed to what that property can generate on a monthly basis because it's also seasonal, a lot of volatility. So if you go in to get an investment property and you say, traditionally, I'm going to get an occupant in there, I'm going to sign a year-long lease. It's a pretty easy mathematical equation. For an Airbnb property, there are other factors too that you need to consider. You need to consider when you clean it up. You need to consider getting somebody in the property. How many days vacant is it? As a bank or a lender, is this too risky for us to invest in? And most banks and most traditional lenders have chosen the path of, yes, it is too risky. And a great example of that is the pandemic. A lot of people who had Airbnbs, these vacation properties in desirable areas, stopped having people request their property for rent because they were worried about the pandemic. They couldn't travel. They couldn't get there without worrying about exposing their family. And when they got there, they didn't know how clean or sanitary it was. Some people had a little more confidence in hotels. Some people had less confidence in hotels because they were spending more time in the Airbnbs with less people as opposed to a bigger facility. At the end of the day, these things cause people to be very concerned with Airbnb properties. That's not to say that they're not good. That's not to say that you can't operate them successfully. They also require a lot more attention from you, the owner. Me, as a guy who operates single-family rentals and multifamily properties, I sign a lease, the tenant's in the property. My property management company may get a call from time to time as it relates to issues that might come up. There might be some water issues, a toilet might not be working, there might be a sink issue. But by a large part, I don't get bothered by these things and I collect my money every single month minus the property management's fee. With an Airbnb property, it's not quite as simple because there needs to be an operator of the property that's managing the scheduling. And there are third-party companies that work as property management that'll do that for you, but you have to understand it's not as simple as letting them be in the property and pay you your rent. There's also utility expenses that go along with extra cleanings and extra services. You have to pay that property manager a little bit more because they're actively managing your property. They're not waiting for a call to come in for a client and making sure that things are being paid on time. It's a lot more hands-on and a lot more intensive. So if you're going to go to somebody and say that you're getting a property to make an Airbnb, most traditional lenders are going to say no because they don't want to deal with the extra complicated nuance. They feel like in a worst case event scenario of a foreclosure, where they take the property back from you, that property will not generate as much money. I can't just step in the shoes as a bank of the previous owner and continue to collect rent. So I'd have to hire a third-party company and make sure I can collect on the hospitality. And now I'm running a hospitality business on an Airbnb. So most lenders generally pass on that. What happens? Some sophisticated borrowers will just not tell the bank they're renting them out that way. Some sophisticated borrowers will go get a refinance and they'll try to say that this property is it's owner occupied. And these things come up over time. If a bank finds out about it, it's going to be an issue. And the number one way it typically comes up is when they see your insurance come through and it's got some of the added benefits that you're going to need for renting a proper Airbnb property. Your lender's now going to be on notice that you're operating a transient property and they're going to contact you and saying that you're in technical event of default of your loan documents. So what's the best plan of attack? If you're going to get into an Airbnb property, understand the hospitality business, understand renting it out, know the people that you're working with. And really, if it's your first one, you should understand how to operate the property without your property management company and only let them step in once you've kind of mastered the basics. Understand if you go to a lender, the lender's probably going to require more down because it's an inherently riskier product for them. And they generally want to mitigate that risk by having you have more equity or more skin in the game in the form of a down payment. Once you do that, Your payments will be less because you put more money down. And number two, the bank will feel a little bit more comfortable with the fact that you're running a riskier based business, but you're going to have to qualify based on your income. Understand that the speculative nature about what it could earn is not the bank's concern. They're going to underwrite to what you can qualify for based on your cash flow basis, based on your historical tax returns. So if you're trying to buy an Airbnb property because you think it's going to make you an extra $100,000 a year, they're not going to give you a pro forma projection based on what you think it could do for you. They're going to say, can this person qualify for this home based on their existing income? And then next year when you file your tax return with that added income, hopefully, you'll then be able to get another property. So what have we learned today? Me personally, I like consistency in having a property that's very simple and easy to rent out. And yes, I probably make more than some of these Airbnb, or make less than some of these Airbnb properties do. But at the same time, I don't have the inherent risk that they do in operating a business consistently over time, because I've got a day job. I've got several day jobs. I've got a family. I've got other obligations that I want to focus on, and operating that business is not my primary function. If you're looking to buy an Airbnb property, you want to be cautious to avoid HOA associations, or at least investigate them when you're looking to buy them. Some HOAs prohibit transient occupancy. They don't want, short-term rentals. They don't want rehab facilities. You got to understand the area that you're getting into. Not all Airbnbs are located in what you would think would be your classic, iconic, desirable vacation properties. Don't think like Big Bear or the mountains or resorts or beaches. Some of them are located next to large shopping areas like big malls and things of that nature. So it doesn't necessarily have to be near a large attraction, but it certainly helps to do so. But there will be a lot of competition, and a lot of these bigger markets are saturated. So know the markets you're getting into. There's a completely separate set of research you have to do. That's all for this week. Thank you for watching. Please like, follow, subscribe. We hope that we provide some value to you.